Welcome to Witham Sounding Board, a podcast sharing powerful business tips, insights, and trends for those seeking to become a rock star in their industry.
Good day, everyone. Today, Witham will be talking about the issues facing newly made partners at law firms. My name is Hal Margolett. I'm a CPA and tax principal at Witham's Princeton, New Jersey office, and I have with me my colleagues, Natalie Chance, a CPA and a senior tax manager at Witham's Orlando office, and Nisha Banushali, a CPA and a tax manager affiliated with our San Francisco office. Collectively, we have over 55 years of experience working with professional service firms such as law firms and their owners. Today, our focus will be on tax and financial considerations that new law firm partners or shareholders need to take into account as they transition into their new roles. We will mainly concentrate on issues related to new owners of pass-through entities, such as partnerships, limited liability companies, and S corporations.
Thank you for joining us today. In addition to pass-through entities that Hal mentioned, we will also be examining how new shareholders and C corporation law firms should approach dealing with their own set of tax issues. As we will soon discuss, owners of different types of entities have somewhat different concerns to deal with.
That's right, Natalie. Congratulations on your recent promotion to partner or shareholders at your law firm. This is a notable achievement attained after many hours of work and dedication to your profession. Today, we will be discussing the many ways your financial life will be changed as a result of this promotion and how to handle those changes.
If you have been made partner or shareholder at your law firm, there are three main types of entities that you will be working for. Your business is a partnership or a limited liability company that is elected to operate such as a partnership. Your law firm could be operating as a S corporation or as a C corporation. Partnerships are entities that pass through their activities to their owners. Their partners are LLC members, and income is picked up and taxed at the partnership level rather than at the firm's level. Partners do not get a W-2. They receive a tax statement known as a Schedule K-1. This K-1 schedule shows the allocation of income, deductions, and other tax attributes, such as credits, that are allocated to individual partners. It prevents a unique set of circumstances for the new partner.
S corporations present their own set of topics to deal with. An S corporation is also a pass-through entity. However, being a corporate shareholder and employee, you'll be receiving two statements, a K-1 and a W-2. There will be some challenges as well as some opportunities in this environment.
The final entity we will be discussing is law firm owners of a C corporation. Owners of these entities receive only W-2. They are usually the easiest entity to plan for, but these entities lack the flexibility that a partnership would provide. Even though you will only be receiving a W-2, there still may be a planning opportunities available that will be talked about.
Now let's talk about the pass-through entities, namely partnerships or S corporations. These entities, during tax season, will be issuing you a new type of tax document instead of a W-2. But remember, in an S corporation, you'll still receive both. Your income and losses and credits will all pass through directly to you and are not taxed at the entity level. And you should be picking them up on your personal income tax return. Make sure to wait for this K-1 before you file your personal tax return. Partnerships can allow for the ability to specially allocate income, deductions, distributions, but this flexibility comes with an added complexity to the owners.
Being an owner of a partnership or an S corporation that does business in multiple states can possibly subject you to tax filing requirements in all those states. For example, if your firm operates in New Jersey, Pennsylvania, and Delaware, you may be required to file a state tax filing in all three states based on your proportionate amount of income that's been earned in those states.
In addition to a tax compliance in most jurisdictions, partner of partnership and a shareholder of a S corporation receiving an income through their K-1 will not have any federal and state taxes withheld from their earned income. You will now be required to pay your taxes yourself instead of the company withholding them from your W-2. These tax payments generally need to be made by April 15, June 15, September 15 of the current year, and January 15 of the following tax year. You are required to make these quarterly payments if you are projected to owe $1,000 or more for the year.
The internal management of your law firm knows all about these top tax obligations and will generally be making distribution of profit, known as a tax distribution, especially to you to meet these obligations. It is important that you budget your expenses so these distributions will be available to pay any quarterly taxes due. Federal estimated taxes, however, states may or may not adopt these federal rules, because each state is different, are computed using one of two methods. Adoption of one of these methods will help you avoid any underpayment estimated tax payment penalties.
As Hal mentioned, there are two methods available for calculating and paying estimated taxes. The first method is based on your prior year's tax. If you have adjusted gross income, or AGI, is under $150,000 for the prior year, then you would pay 100% of the prior year's tax liability equally over the 4 quarters. But if your AGI is over $150,000, it would require an estimated tax based on 110% of the prior year tax. While this method is very easy to use and implement, it does have some drawbacks.
For example, what if your prior year tax was higher than the current year's projected tax? A law firm partner would be paying in way too much in estimated taxes and be substantially overpaid until receiving their refund after they file. To meet this situation, a second method is available, the annualized installment method. This method is based upon paying 90% of your current year's estimated taxes due. This method offers the most amount of flexibility but adds the additional work of computing your income on a quarterly basis.
By the way, these methods and the information being asked by you to your chief financial officer of the firm, they should be well aware of these obligations that you have to meet and the information that you need from the firm, and should be providing you quarterly information necessary to calculate these estimated taxes using the annualized installment method. Depending upon your partnership agreement and the financial results of your law firm, you may also be receiving tax distributions of money to assist you in meeting your quarterly tax obligations.
Now, only in partnerships, you may also be subject to different types of compensation. This is depending on your partnership agreement and the deal negotiated with you upon admittance into the partnership. And it usually depends upon the type of partner you are. Are you an equity partner or are you a non-equity partner? Non-equity partners will get a K-1, but are generally paid in a manner set periodic payments from the partnership. These are known as guaranteed payments. These payments are usually guaranteed regardless of the company's profitability. However, there's one drawback to this method of compensation. While it is guaranteed, this is usually all the compensation you'll receive. You will not be receiving tax distributions, so it's important to budget properly and make sure that their funds are set aside for these payments to make sure you can pay your estimated taxes.
Again, depending upon your agreement, if you are an equity partner, you will primarily be receiving profit and tax distributions from the partnership that represent your share of the partnership's profits paid out in cash. These will be reported on your K-1 statement. Note that some firms hold back a portion of their profits to fund ongoing operations or other cash flow needs. For this reason, it's important to know that your distributions sometimes will not be a dollar for dollar payout of the firm's profits that are attributable to you.
One underlying theme here is that you need to refer to your partnership agreement to determine how you will be compensated in order to provide the funds necessary for paying your estimated taxes. You should also communicate with the firm's finance department to get information as to the timing of your distributions and when you will receive the financial information necessary to calculate your current year taxes and tax payments.
You should also be aware that even though you're likely to be compensated well above what you previously made as an employee, you will also need to pay self-employment taxes, which is FICA and Medicare. And you used to pay that through your W-2, but now you have to pay it on your personal tax return. And this is in addition to your income taxes. But all is not lost. You'll be able to deduct approximately 50% of what was paid for these taxes on your personal tax return anyway. So, and then in addition to these things, you may also be able to deduct unreimbursed business expenses. and you may be eligible for larger pension benefits.
As a law firm owner, employee receiving a W-2 from a S corporation or a C corporation sometimes has its own complexity. You receive a W-2 as a non-owner employee, your year-end bonuses are not taxable to you until their receipt. As an owner employee, any accrued bonuses may be taxable now, even if not paid yet. You may be paid in a subsequent year. So it's important to determine the timing of the bonus to make sure enough funds are set aside to cover your tax withholdings or any estimated taxes due.
As one can see, law firm ownership, while providing an opportunity for tremendous career and income growth, can also cause additional administrative burden due to your increased tax compliant requirements. As touched upon earlier, ownership in a pass-through entity such as a partnership or an S corporation may require you to file in additional states or even have an international tax reporting commitment if the firm has offshore international business activities.
However, some of these complications can be lessened by proper planning in conjunction with your tax or your firm's tax filings. Certain states will allow partners or S corporations to file with their colleagues in what is known as a composite tax filing. As long as your law firm income from a particular state is your only income from that state, then you can group your income with those of your colleagues into a singular group personal tax filing. This is done at the firm level. You usually need to make a special tax election, and the firm has to be willing to do this. You would not be required to file your own individual tax filing in that state, and that kind of lessens the burden, the administrative burden off of your shoulders. One downside of this option, though, is that your income is usually taxed at the state's highest individual tax rate. And another downside is that by filing in a particular state, you may wind up paying less than you would on a composite tax filing. But for many partners, the convenience and lower cost of tax compliance for the firm filing it on a composite return outweigh this higher tax cost.
In addition, your firm's finance department may be paying non-resident taxes on your behalf. This usually means your payment obligation has already taken care of by your firm, but you still will be required to file a state return. The third option is the new pass-through entity tax regime that have been adapted by various states to get around the Tax Cut and Jobs Act of 2018 that severely limited the ability to deduct state taxes on individual federal tax returns. The firm would pay the state tax on your behalf, get a direct deduction against earned income, which is passed through to you in a lower taxable income, and you would be able to claim a credit on your personal state return for this taxes paid on your behalf.
Some of you may be asking, what if I only receive a W-2 and my firm is organized as a C Corp? You will not be receiving a Schedule K-1 statement, and your administrative onus is substantially reduced. Estimated taxes may be warranted, though, especially if you receive a bonus and the amounts to be paid in for pension or 401k plans may need to be calculated. As we have been saying throughout the podcast, you need to refer to your partnership agreements and be in constant communication with your finance department.
We'll be providing a checklist with the relevant points to be considered for your new law firm partners, and it will be provided with the materials for this webcast.
In summary, the major takeaway of this podcast is things you need to consider are as follows. Review your partner's agreement to determine when and how you will be compensated. Be in communication with your CFO or a finance department to determine what your projected income from the firm may be for estimated tax calculations. Develop a personal cash management plan so the funds will be available to make your tax payments, whether it's estimated due or year-end planning. If you are the owner of a pass-through entity, you may need to make estimated tax payments, which is due by April 15, June 15, September 15, and January 15 of the following year. You may need to file additional tax returns. If you are required to file and pay taxes in additional states, you should contact your finance department to see if a composite tax filing election is available or not, and if non-resident tax payments are being made by the firm on your behalf. In a corporate settings, you may receive a W-2 payroll bonus. However, the withholdings on the bonus may not be enough, and you may need to make an estimated tax payments or provide for additional tax withholdings on the bonus, and we can definitely help you with that. Refer to our checklist that Natalie mentioned for additional consideration.
Congratulations and good luck in your new role. And Witham is here to help. Please do not hesitate to contact us if you have any further questions. Our contact information is available with the podcast.
Thanks for joining us. Be sure to subscribe to our podcast so you'll be first in line to hear what's coming next. Don't want to wait for our next episode? Check us out at witham.com. That's WITHUM.com.